Exchange. I'm joined live in the studio by the Director of Lombard Street Research, Gabriel Stein. Thank you very much indeed for coming in today. If we just look at what's happening with Brazil, I mean, there's other countries as well, like Indonesia. They're being very hard hit by what effectively is a devaluation of the US dollar by quantitative easing. What can they do? What option does a country like Brazil have?
At the end of the day, probably very few, because the Fed has all the ammunition it wants, and even though they repeat the mantra about the strong dollar in the interests of the US, if they want to push it down, and that is very clearly the aim of QE, they can do it. Now, there are some things they can do. You've seen the Brazilians do some of them, impose taxes and so on. You can do, for instance, what the Taiwanese did. I don't know if the Brazilians have done it, but you can say if you put money, if money comes in, it has to be parked for a period of time, or there's limits to how long you can park. There are different ways of attempting to regulate capital flows, and ultimately there is, of course, capital controls. To some extent, I think Brazil's, Indonesia's, others' problem is that they are the innocent bystanders. This is a US-China shootout, and they happen to be on the wrong side of the street.
And is there any sense in which you could see that there would be a kind of a coalition of all these countries that have been victims, if you like, of the currency wars? They can't really, there's not an awful lot they can do, is there, to put pressure on the US?
No, there isn't. They can try to counter it by lowering the value of their own currencies. And let's be clear, Brazil has not, they have only tried to talk down the real, but they have tried to talk down the real. I think what perhaps would be more important is if they understood, and that's probably true for the Americans as well, that it's actually not the exchange rate of the currency that matters. It's its stability, its lack of volatility. The less volatile, the more stable. Countries, households, companies, etc., they all adjust, exporters and importers. In terms of a coalition of the willing, so to speak, to boost the value of the dollar, not sure if they have the ultimate firepower to do so, and their respective interests vary too much anyway.
Right. Now, just while we have you here, we've been talking our top story today about the various countries, Ireland particularly, Greece and Portugal, and their various debt issues. Ireland and Portugal are particularly getting a bit of a hammering in the markets at the moment. What's Ireland's position?
Ireland has a real issue, obviously, with its debt and its deficit. And every time these things happen, the situation is exacerbated because markets realize they're going to have to borrow at ever higher interest rates, which makes the necessary adjustment harder, and so on. And ultimately, will they have to go to the FSF and borrow, which is the first step in a default? They probably, under normal circumstances, would not need to. But these are not normal circumstances. They are at risk of being caught in a vicious circle where each time they try to do something, they tighten more. That depresses growth further. Markets don't believe it's going to work. Rates go up, and so on. And part of this, of course, goes back to the German insistence on imposing an orderly default procedure. Indeed. There is no need to have a default procedure if you don't think people will default. If you have one, there will be defaults.
Thank you very much indeed for joining us today, Mr. Stein.
Thank you.